So you've taken the leap and you've launched your company. Now you're trying to figure out how to fund it. Well, a SAFE might be the perfect way to structure the deal. Over the years, I've worked with founders to raise millions of dollars on SAFEs, and based on that experience, I hope this video will help you understand whether or not the SAFE is right for you. Of course, none of this is legal advice. If you're raising capital, you definitely want to be working with competent startup legal attorneys. And if you don't have one, feel free to reach out to us at westaway.co. Now let's dive in. So what is a SAFE? A SAFE is a simple agreement for future equity. As the name implies, the investor is giving the company a certain amount of capital that may convert into equity in the future under certain circumstances. It was created by Y Combinator, the preeminent startup accelerator, in 2013 and has since exploded in popularity. It's become by far the most popular way to raise early stage financing for startups. It's incredibly popular with founders because it's quick, simple, and very founder friendly. What are the advantages of the SAFE? The SAFE is fast and simple. It's a 6-page document that anybody can see on Y Combinator's website. It's heavily standardized, so that means that there's not much negotiation happening between investors and founders. It requires a pretty light touch from attorneys as well. In a convertible note, if you don't convert the debt into equity at the maturity date, you have to pay back all of the principal plus accrued interest. That's not the case with a SAFE. In a SAFE, if you never convert, you never have to pay back the investor. Now, what are the disadvantages of the SAFE? One of the major disadvantages of the SAFE is it's almost too easy to use. Because it's so quick and simple to bring in capital to your company using a SAFE, it's really common for founders to stack SAFE on SAFE on SAFE on SAFE without really having a clear insight onto how that's going to impact their cap table. So whenever it comes time for those SAFEs to convert into equity, founders oftentimes find themselves feeling really sad for having given away so much of their company. Let's talk about how the SAFE actually works. A SAFE converts into equity at an equity financing. The equity financing is your next priced round of capital that you bring in. And this would exclude any convertible notes, it would exclude any SAFEs, but it would be the next priced round that you have. At that equity financing, the SAFE holders convert into preferred shareholders with the same preferences and rights as the new investors. The question is, how many shares do the SAFE holders get for the amount they've invested in your company? Well, that all depends on whether the SAFE has a discount and or a cap. First, let's discuss discount. The discount is the discount on price per share relative to the price that the new investor is paying. And that discount ranges from 15 to 25%, with 20 being the most common discount rate. Let's assume a SAFE holder has put in $100,000 to your company and they've done so at a 20% discount. Let's also assume that the new round that you're raising is at $1 per share. So the SAFE holder will pay 80 cents per share instead of the $1 per share. And that means they get more bang for their buck. They get 125,000 shares for their $100,000 investment because they have that 20% discount on their SAFE. Now let's discuss the cap. The cap is the highest valuation at which the SAFE will convert into equity in your company. Let's assume that you have a SAFE holder with a $10 million cap, and then you have a new round of financing that comes in at a $20 million valuation. So that SAFE holder will be paying half price per share relative to the new investors. It's important to note that many SAFEs have both a discount and a cap. In that scenario, the SAFE will convert in whichever way gives the investor the most shares in the company. So what's best for the founder? A discount or a cap? All things being equal, and if you have the power in the negotiation, what you'd like to negotiate for is an uncapped but discounted SAFE. The discount gives the investor a premium for taking a risk on your company early, but it sidesteps that whole messy negotiation of trying to put a valuation cap on a very early stage company. So that's the best case scenario. But the most common scenario is actually that most founders sign SAFEs that have both a discount and a cap. Now that you understand caps and discounts, let's talk about MFNs. MFN, or the most favored nation clause, allows SAFE investors to get the same terms as any future SAFE investor that comes down the line. So say, for instance, there's a more powerful or more savvy or more rich investor that comes in the future and negotiates a better term for their SAFE. The previous SAFE holder that has the MFN clause is allowed to upgrade to those terms. In general, if you can avoid the MFN clause, do so. It's very easy for these MFN clauses to get out of hand and for you to inadvertently give away more of your company than you intended to. Lastly, let's discuss side letters. Side letters are a supplemental agreement to the SAFE. Y Combinator has a standard SAFE side letter that includes pro rata rights. A pro rata right is the right for an investor to continue to invest in future rounds to maintain their current equity position. So let's say that a founder has 10% in the company after a round closes, they have the right to invest enough capital to maintain that 10% position in the next round. Now, the pro rata right, I think, is pretty neutral, and it's fine for founders to sign a side letter that has a pro rata right on it. However, if you see a side letter that has the pro rata right plus a laundry list of other rights for the investor, that should raise a yellow flag with you. You definitely want to look at that very closely with your counsel, and oftentimes it won't make sense for you to accept that investment if there are a ton of conditions attached to it. If you want a deeper dive, check out our Founder's Guide to Safes in the link below. If you're still trying to figure out whether or not the safe or the convertible note is the right fit for you, check out my video on convertible notes.